Hey y'all, it's your girl Meg here, and I am back with another video today on debt to income ratio. And debt to income ratio, or DTI, in the real estate world, it's just simply how much money can you afford. Okay, that's the simplest way I can put that term and what it means. Okay, your lender will take into account the amount of money that you make pre-tax and the amount of money that you spend monthly on your expenses. And then they will take that and they will divide it together and come up with your debt to income ratio. So the official equation for that, if you're wondering how to calculate this on your own, is your monthly expense divided by your pre-tax income. And then you get your DTI. So for the purpose of this video, pre-tax income is going to be $5,000. Okay, $5,000 a month. It just makes it easier for the numbers, cleaner presentation, y'all. So if your pre-tax income is $5,000 a month, and say your outgoing bills are $2,100 a month, well, your debt to income ratio is 42%. Same pre-tax income, $5,000, but your outgoing bills are $3,500. Well, now your debt to income ratio is 70%. And you may be thinking, okay, well, I still, have some money left over. I still have some wiggle room. Well, most of the time when you decide to buy a house or make this jump into home ownership, things are probably going really well in your life. You probably have a new job, or you got a promotion, you're making more money. Something has prompted you to say, I am ready and I am financially ready to make this purchase. Well, what happens if you lose your job? Or if the company can't maintain as many employees, and say for instance, your hours could get cut down. You may not even lose your job, but your hours might get cut. Well, now that you might find yourself struggling a bit to maintain your lifestyle and maintain those monthly expenses. Well, your lender thinks about this, okay? They think about those what ifs and if this happens and things like that. And they want to make sure that you can essentially afford your home. They want to make sure they're not going to have to foreclose on you. Because if I lost my job, it's probably a lot easier for me to maintain $2,100 a month versus me maintaining $3,500 a month. You see where I'm going with this? So they're going to examine all of your finances to figure out what it is, what you can afford, essentially. Okay? So at this point, you might be wondering, how much debt to income ratio can I have? Like, what's the number that I need to be, depending on the lender? Because, and also your loan type, whether it's conventional, FHA, USDA, or VA. So certain loan types have a certain debt to income ratio requirement, and certain lenders impose debt to income ratio requirement. So the 43% is the average number, okay? It can fluctuate. So, and just to give you an example, say if your lender says, well, for this type of loan, you need a debt to income ratio of 41%, but you have a debt to income ratio of 42. Now, typically that 1% is not going to stop you from getting your loan, but that 1% may come with additional obligations that you have to meet. So for instance, they might say you need to have 2 months of reserve mortgage payments. So in addition to whatever you have to come to the closing table with, you might need 2 times your monthly mortgage payment in a savings account somewhere or some type of other account, and provide proof of that you have that money to the side, because they're concerned because of how much debt and outgoing money you're spending. They're worried that if something happened, you're not going to make your payments. So the ideal debt to income ratio is 36%, okay? Now, let's go ahead and put this into perspective. We're still working on our 5,000, y'all. I told y'all from the beginning, we're staying with 5,000, okay? If you were to make 5,000 pre-tax and your outgoing debt was, say, 1,800, well, now your debt to income ratio is 36%, the ideal debt to income ratio. Well, let's say if those outgoing expenses increase to, say, 2,100. Well, now your debt to income ratio is at 43%. So, and I take that back. Your debt to income ratio is 42%, not 43. So, say if, for instance, if you had increased that 1,800 to 2,100, you now have a debt to income ratio of 42%, which sounds a lot better. But the point that I want to make is that 1,800 to 2,100 is not a significant difference. It's not a whole lot of money in between, but it is a difference in terms of debt to income ratio. So keep that in mind when looking into that. Now, the number one hiccup, I don't care how many times I have seen someone go through this process, the number one hiccup with debt to income ratio are student loans, okay? Now, especially when those student loans are in deferment. That is the infamous line I love. Like, yeah, I got some student loans, but they in deferment right now. Like, they don't even matter. Oh, yes, the fuck they do. They matter. They matter a lot, actually. Because if your student loans are in deferment, your lender is going to say, yeah, you don't owe any money right now, but you will owe some money soon. So they have to take that into account, because you have to remember, typically your mortgage agreement with your lender is not like an apartment agreement where it's just a couple of years here, a couple of years there. No, this is a 30-year time frame. So they're looking at the fact that you might be in debt with them for the next 30 years. So they have to consider the fact that those student loan payments are going to become due. So with that being said, if they are in deferment, your lender will automatically calculate 1% of your student loan as your monthly student loan payment. So say, for instance, if your student loans are $50,000, okay, and don't act like that is a exuberant amount that I came up with, because I know some people with $50,000 worth of student loan debt. Well, 1% of $50,000 is $500. So your lender is going to take whatever you are currently already spending every month out, and they're going to tack in $500 that, even though you're not spending it right now, you will spend it. And they are going to add that into your monthly out to come up with your debt to income ratio. I have seen this go horrible for people, where they have gotten to this point. They're like, I have a pre-qualification. Their lender is like, great. They saw the credit report. They saw $0. They assumed you didn't owe anything. They send it to their underwriter. The underwriter looks into it, and they're like, no, she owe $50,000 right here. They owe $50,000. So then they're going to send it back and say, their debt to income ratio is too high. And depending on where you are in your process, whether you've submitted a contract, put down earnest money, things like that, you could be losing that earnest money because you can't fulfill the obligation of the loan. You can't get a loan because you have too much debt. So before you get into that process and like, oh, I got a better job, you know, I make $60K now, I want to get a house, all these other things, you need to take a moment, pause, talk to your lender, talk to your realtor, and really sit down and have the honest conversation. Like, when you sit down with your realtor and your lender, this is not the time to be like, I need to have all my fucking business. I don't need them. I don't want them in my finances. No, we need to know your finances, because we don't want to get to the table and then they're like, oh, she can't get this house. And then I have to come and tell you, you can't get your house. Then you done told all your friends and your family you got a new house coming. It's just a domino effect of heartbreak, y'all. Heartbreak. So don't do it. Just have the honest conversation up front so you know where you stand. But then also you can find out if it's something you can pay off that's smaller, that, you know, it's like, when you think about that debt to income ratio, remember it's the monthly outgoing expenses. So if part of that is a credit card, no, you might not be able to pay those student loans off, but you could pay that credit card down. That means you have less money out, but you still have the same income. That changes, okay? And as we have seen, 1,800 to 2,100 it made a larger difference in the percentage of debt to income ratio, but in reality, it was not a huge amount of money difference. So remember that, have the honest conversation, and figure out what your debt to income ratio is, where you need to get it to be, so that you're ready. So that when you do go through that process, there are no surprises. Because I'm going to tell you, we don't like surprises, and we don't want to have to deliver surprises to you. I know I don't. I don't like surprises. I want the process to go from beginning to end the way it should. So debt to income ratio, if y'all want to talk about it, you want to get the equation again, go watch the video again, okay? Don't forget to subscribe, because there will be more content coming. I will see you all next week.